Evening class, and welcome to Synapse Global Institute. I am your instructor for Advanced Financial Reporting and Analysis, and in this session, we are working through a full mock examination question on group financial reporting, designed to integrate and test your understanding of IFRS 10, IFRS 3, IAS 28, and IAS 21 in one comprehensive scenario. This type of question reflects the standard, depth, and integration expected at CPA Advanced Level, and it requires not just calculations, but strong conceptual linkage and disciplined presentation. The question begins with the background information, which immediately sets the consolidation framework. On the 1st of January 20/9, Apex Limited acquired two different types of interests. First, it acquired 80% of the ordinary shares of Zenith Limited, a local company. This level of ownership gives Apex Limited control, meaning Zenith Limited is a subsidiary and must be fully consolidated in accordance with IFRS 10. Second, Apex Limited acquired 30% of the ordinary shares of Nova SA, a foreign company whose functional currency is the euro. This level of ownership gives Apex Limited significant influence, not control. So Nova SA is treated as an associate and accounted for using the equity method under IAS 28, with foreign currency translation under IAS 21. These ownership percentages are critical because they determine whether we consolidate line by line or bring in a single line investment balance and share of profit. We are then given the statements of financial position before consolidation, as at the 31st of December 20/9. Apex Limited reports property, plant and equipment of 1,200,000 shillings, an investment in Zenith Limited of 600,000 shillings, and an investment in Nova SA of 450,000 shillings. It also holds inventory of 420,000 shillings, trade receivables of 260,000 shillings, and cash and bank balances of 180,000 shillings, giving total assets of 3,110,000 shillings. On the equity and liabilities side, Apex Limited has share capital of 1 million shillings, retained earnings at the beginning of the year of 620,000 shillings, profit for the year of 240,000 shillings, and trade payables of 450,000 shillings. These figures form the parent's baseline and are the starting point for consolidation. Zenith Ltd's statement of financial position shows property, plant and equipment of 800,000 shillings, inventory of 300,000 shillings, trade receivables of 180,000 shillings, and cash and bank balances of 120,000 shillings, giving total assets of 1,400,000 shillings. Its equity consists of share capital of 500,000 shillings, retained earnings at the 1st of January 20/9 of 300,000 shillings, profit for the year of 200,000 shillings, and trade payables of 400,000 shillings. These figures will be combined line by line with those of Apex Limited. Subject to consolidation adjustments, for Nova SA, the foreign associate, we are given net assets at the 1st of January 20/9 of 2,000 euro units, profit for the year of 400 euro units, and dividends paid of 100 euro units. Because Nova SA's functional currency is the euro, these figures cannot be used directly. They must be translated into Kenya shillings using the appropriate exchange rates under IAS 21. The exchange rates provided are 100 shillings per euro at acquisition, 110 at the average rate for the year, and 120 at the closing rate. The additional information provides the key consolidation adjustments. At the date of acquisition, the fair value of Zenith Ltd's net assets was 700,000 shillings. This figure is essential for calculating goodwill under IFRS 3. We are also told that Apex Limited measures non-controlling interest at the proportionate share of net assets, which affects both goodwill and equity attribution. During the year, Apex Limited sold goods to Zenith Limited for 200,000 shillings at a markup of 25% on cost, and goods with a selling price of 80,000 shillings remained unsold at year-end. This introduces an intra-group unrealized profit that must be eliminated in full because the transaction is downstream and Zenith Limited is a subsidiary. Finally, taxation is to be ignored. Simplifying the analysis, in preparing the consolidated statement of profit or loss, we begin by focusing on consolidation adjustments rather than recomputing detailed revenue and expense lines. The unrealized profit on inventory is calculated by converting the selling price of 80,000 shillings back to cost using the markup relationship. A markup of 25% on cost means that cost is 100 out of 125 of selling price, giving a cost of 64,000 shillings and an unrealized profit of 16,000 shillings. Because this profit arises within the group and the inventory is still held at year end, it must be eliminated in full from group profit. We then incorporate the associates' profit. Nova SA's profit for the year is 400 euro units, of which Apex Ltd's share at 30% is 120 euro units. This share of profit is translated at the average exchange rate of 110 shillings per euro, giving a group share of 13,200 shillings. This amount is added as a single line item in the consolidated statement of profit or loss, in accordance with IAS 28. The consolidated profit calculation then combines Apex Ltd's profit of 240,000 shillings with Zenith Ltd's profit of 200,000 shillings, deducts the unrealized profit of 16,000 shillings, and adds the share of associate profit of 13,200 shillings. This results in a total consolidated profit for the year of 437,200 shillings. This profit must then be attributed between the owners of Apex Limited and the non-controlling interest. Zenith Ltd's adjusted profit after unrealized profit elimination is 184,000 shillings, and the non-controlling interest at 20% amounts to 36,800 shillings. The remaining profit of 400,400 shillings is attributable to the owners of Apex Limited. We then move to the consolidated statement of financial position, beginning with goodwill on acquisition of Zenith Limited. The consideration transferred by Apex Limited is 600,000 shillings. Non-controlling interest, measured at 20% of the fair value of net assets at acquisition, amounts to 140,000 shillings. The fair value of Zenith Ltd's net assets at acquisition is 700,000 shillings. When these amounts are combined, goodwill arises as 40,000 shillings. This goodwill is recognized as an intangible asset in the consolidated statement of financial position. Group retained earnings are then determined. Apex Ltd's opening retained earnings are 620,000 shillings. To this, we add the group share of Zenith Ltd's post-acquisition profit, calculated as 80% of the adjusted profit of 184,000 shillings, giving 147,200 shillings. We also include Apex Ltd's profit for the year of 240,000 shillings. This results in closing consolidated retained earnings of 1,007,200 shillings. The investment in the associate is then updated using the equity method. Starting from cost of 4,500 euro units, we add Apex Ltd's share of profit of 120 euro units and deduct dividends received of 30 euro units, giving a closing balance of 4,590 euro units. This balance is translated at the closing exchange rate of 120 shillings per euro, resulting in an investment in associate of 550,800 shillings. Finally, we prepare the consolidated statement of financial position. Property, plant and equipment is the sum of Apex Ltd's and Zenith Ltd's balances, giving 2 million shillings. Goodwill of 40,000 shillings is added, along with the investment in associate of 550,800 shillings. Inventory is adjusted to remove the unrealized profit, giving a consolidated balance of 704,000 shillings. Trade receivables total 440,000 shillings, and cash and bank balances total 300,000 shillings. Total assets therefore amount to 4,034,800 shillings. On the equity and liabilities side, share capital remains that of Apex Limited at 1 million shillings. Retained earnings are 1,007,200 shillings, giving equity attributable to owners of 2,007,200 shillings. Non-controlling interest amounts to 176,800 shillings, reflecting both its share of net assets and post-acquisition profit. Trade payables of Apex Limited and Zenith Limited are combined to give 850,000 shillings. Total equity and liabilities reconcile exactly with total assets. In conclusion, this full mock exam question demonstrates how modern CPA Advanced Examinations test comprehensive consolidation, requiring candidates to integrate control, significant influence, foreign currency translation, goodwill, unrealized profits, and equity attribution into one coherent answer. Success in such questions depends on a clear understanding of the standards, logical sequencing of adjustments, and precise presentation, all of which we have illustrated in this session.